This conference will now be recorded.
So good morning, everybody. People are still arriving, but it's a couple of minutes starting time, so I think we'll kick off. I apologize for the bings that keep coming on my computer, but can't turn the speaker off and talk at the same time. We have a panel this morning, which is going to be led by John Forbes, but I'm just going to say for a couple of minutes what AREF has been up to and what we're going to continue to be up to. So at the moment, everything is about communication between members, between membership and government, bank and FCA, which have started to call themselves the triumvirate, and between AREF and other organisations. There are other mechanisms which were in place before this all blew up, which have proved to be very useful. So just to let you know everything that's going on, AREF's a member of the Property Industry Alliance, which is AREF, British Property Federation, IPF, RICS, British Council for Offices, REVO, which is shopping centres, CREFC, which is debt, and the ULI. And they've got very useful links into the Ministry for Housing, Communities and Local Government and the Bank of England. We all have daily calls, which are proving to be very useful. We're all reinforcing each other's messages into government. We also have a pan-European European Real Estate Forum where we have fortnightly calls. It's less immediate and less particularly relevant to the UK, but it's interesting to see how different countries are dealing with the issues, and we're all facing the same issues. And I have email correspondence with other organisations in the US, Canada and Australia from around the world. I mean, the picture there is that Europe appears to be ahead of North America in terms of valuation uncertainty and open-ended fund suspending, but I think that's going to be coming. I think the most useful thing relationship is with the Investment Association, whereas, you know, we're a special member. They have fantastic links into the government, and the Investment Association has daily calls with what is now being called the triumvirate, which is government, bank and the FCA, who thankfully have started to realise that they've got to link up, and they specifically asked for these calls, which are with those three, Investment Association, Association of British Insurers and UK Finance. So it's covering the whole financial sector, banking, insurance and investment. And they're hungry for daily real-time information. So if there's anything that you want to get fed into those organisations at that level, please send it through and I can feed it into those calls. Myself, I've got 2 weekly calls, one with the Treasury and one with the FCA along with the valuers, and the FCA is very keen to monitor the valuation situation and see how that's developing, how we may come out of it and how that may affect suspension. In terms of what AREF is providing, we have a coronavirus information webpage set up, which is available to members and non-members alike, just as an information facility. So please visit that and see what's there. We're running a series of webinars, of which this is one. We have one upcoming on Asia, bringing in some speakers from Asia because they're ahead of us and it would be good to learn from what they're doing. And we have a weekly drop-in call on Thursdays, which is developed from the calls that we had with the retail open-ended funds and the institutional open-ended funds, which anyone is welcome to join in. It's simply a forum for communication across members. So that's what's going on. I'll just deal briefly with the issues that are the subject of those conversations. So past issues, valuation, fund suspensions, FCA and investors are broadly happy and realise it's the right thing to do, and it's widely understood it's valuation, it's not liquidity. MSCI, we've had conversations with MSCI about the index, and it's likely that they're going to be putting some kind of caveats on the index, which they will still publish, and we've been involved in discussing what that should be. I think current issue, rents not being paid, impact on distributions and interest payments, and the impact on the pension system. I think one thing that's interesting is that everyone in government has realised that you can't just stop the pain somewhere. You can't stop it at tenants and put it on to landlords. You can't stop it at landlords because then the pain goes on to shareholders, and shareholders are not fat cats, it's savers and pensioners. So there's a growing realisation that solutions have got to be applied to the system, not just at one point. It's going to be interesting to see how that develops. Future, I think June's likely to be worse than March. We're likely to start seeing vacancies on the high street. We're starting to have conversations about recovery and regeneration already, and how we support UK PLC through this and how we go into the recovery. And liquidity is still an issue. It was an issue before, it's now even more of an issue. So we're going to be working with the bank, the FCA and the Treasury on liquidity of open-ended property funds, and also getting illiquids into platforms for DC and wealth managers and IFAs. And then the other issues are still there. So climate change, Brexit, technology, ESG, access, diversity, they're still there. They will just be done differently because of the work from home culture, which I think is developing, and social distancing, which will still be there. So we're continuing to work on those and to run events on those. So that's what we're up to. I'd like to say a big thank you to the team, committee members and members. It's really heartening to see the degree of cooperation that's going on. If you've got any ideas you want to input, please contact any member of the team and we will act on it very quickly. So I hope that's useful. I will hand over to John, who's going to moderate the rest of the panel.
Thank you, Paul. Good morning, everyone. As this is the first of these types of webinars we've done, we're doing a couple of housekeeping tasks before we start. Firstly, if you go to the bar in the at the top of your screen and you switch to view active cameras, you should then see me and the four panelists. And we're going to attempt to run this the same as a panel discussion would if we were all in the same room together. I will try to bring in people to ask questions and comments from the audience as we go along. Everyone other than the panelists is currently muted with their cameras switched off. If you want to ask a question or make a comment, please let me know via the chat facility, which is the speech bubble that you see at on the top bar. And when you do that, you will be unmuted and your camera switched on for you to make your comment or question. As you'll be on camera, it's probably best not to do this if you're sitting at home watching this in your underpants. After you've made your point, you'll be turned off again. If you would rather I just read out your question, just put in the question into the chat facility and I'll read it out. We're going to run the panel discussion for about 35 minutes. We're going to bring it to an end at 11. The aim is to keep it short and sharp. We'll have a subsequent series of calls that we can pick up any topics that are of particular interest. So our panelists today, Paolo Alonzi is Global Head of Real Estate Business and Business Finance and Strategy at Aberdeen Standard Investments. He has various roles at AREF on the board, Management Committee and Public Affairs Committee. Guy Glover is a fund manager at BMO Real Estate Partners, and he is the chair of the AREF Retail Funds Committee and sits on the Management Committee. Rob Short is managing partner and founder of Langham Hall, a global provider of administration and IFMD services. And last but not least, Sarah Walker is a senior counsel in the real estate group at Travis Smith. Sarah routinely advises on both buy and sell side in respect of real estate acquisitions and has led the Travis Smith real estate team on a number of high-profile CBA deals. So we've got a variety of topics we're going to try and run through today. We're going to start with the impact of valuation uncertainty and fund suspensions. This impacted the funds for retail investors first in mid-March. So I'm going to start with Guy. Guy, you manage one of the funds affected and have been leading the AREF efforts on this. Could I start with your thoughts, please, Guy?
Okay, thank you, John, and good morning, everyone. Well, as we know, the UK property market started the year full of optimism, with significantly enhanced investor interest and the return of European capital to the market. However, in little over a month, we've gone from a expected Boris bounce to a COVID crash. This was partly as a result of 3 weeks ago, the independent valuers for UK commercial property declaring material uncertainty across the whole UK property market. Material uncertainty is used by the valuers when there is unforeseen economic, political or natural event affecting the ability of the valuers to have a reasonable degree of confidence around the spot number they provide us all with their valuations. The valuers were basically stating that they could not accurately assess the values given the lack of transactional evidence following the government lockdown a few days earlier. This was sort of combined with extensive wider covenant uncertainty, with covenants changing day by day as the impact became clear. And on top of this, in physical assets, it's almost impossible to inspect them currently. So how does a purchaser do their standard due diligence? The lockdown has therefore resulted in the valuation of property assets becoming more art than science over the last 3 weeks. This has resulted in sort of 2 weeks on of about 40 open-ended funds suspended. This is both institutional and retail, and they suspended because of the existing core rules and the FCA guidance, which was published last year, indicating that unit pricing has to remain within acceptable tolerances. There was clear guidance issued that funds should not be using fair value adjustments to try and reflect the uncertainty in the market. Now, as John just mentioned, the daily trended funds have to quote a daily price, and therefore they were the first to move to suspension. They did this because they just could not underwrite the unit price which was being quoted the following day after material uncertainty was declared. And this uncertainty will actually translate not only to institutional funds, which some have already suspended, but maybe more globally as well. Finally, I'd just like to say, worth clarifying, this is not a liquidity event. It's not like 2016 when some funds suspended. Many funds had significant cash buffers and were actually out looking to buy buildings at the present time. So that provides a brief background to why the funds suspended. I don't know, Paolo, if you've got anything else you want to add?
Yes, thanks. Good morning, everyone. You talked about this as a UK, in a UK context, Guy, and I thought it might help if I just provide a little bit of global colour to it, because this is not a UK issue. And I thought best do that in the context of one of the strategies that we run, a global real estate fund, which is an authorised property unit trust and regulated as a non-UCITS retail scheme. The fund is global, as I said, investing circa 80% of its assets in direct real estate, about 20% in listed stocks. And the fund invests in 10 markets currently around the globe, predominantly in Europe and Asia. And a diversified fund, and it's designed to be so, it should be resilient to market shocks, as it was in 2016 when that particular fund didn't suspend, whilst its UK counterparts were largely suspending on the back of the valuation uncertainty and liquidity issues. However, COVID-19, as we all know, is a global issue, and that's now reflected in the valuations of properties across the globe, and therefore, in a European and Asian context for this fund, it's an issue here as well, where we have valuation uncertainty, material valuation uncertainty having been declared across not all markets, but many of the markets in which we invest. And obviously the test we needed to apply was to look at the extent of that uncertainty relative to the 20% threshold that the FCA have specified. So we're above the 20%, which pushed the fund into suspension. What's going to be quite interesting from this point forwards, given the 10 markets that we invest in, is what happens as the valuation uncertainty qualifications are lifted, which I expect will, I suspect won't even be across the UK, done consistently across the UK, across all sectors. But when you look at that in a global context, it's almost certain that we'll not see it being lifted consistently across each of the markets that we're interested in. So we're going to have to spend an awful lot of time carefully monitoring what's happening in each of the markets relative to that 20% threshold, and responding accordingly in relation to the suspension of that fund and the lifting of it. So that's just to provide a little bit of colour in a global context.
Thank you. Before we move on to institutional funds, Guy, can I come back to you on one point, which was, I think the retail funds suspended on the 17th and 18th of March, and I think the FCA had a webcast for with investment association members on the 19th, which I think you were on as well. Was there anything that came out of that that's of interest?
The feedback from the FCA is very much supportive of the actions that the funds have taken. You don't do it lightly to suspend trading in your fund, but it is the right thing to be doing. And I firmly believe, as Paul mentioned, that it's what the investors want us to be doing. They don't want us to be a rush on assets in these funds, then to be suspending for purposes when it's actually not necessary. So the FCA and the Bank of England have been very supportive of the action which we've taken and understand it.
Thanks, Guy. And for people who are interested, I think the text of that speech is available online. And that's the position on the retail funds. I think we'd like to move on a little bit now and talk about what's happened since then with the institutional funds. And before I go to Paolo on that, if there are any valuers on the call who are happy to contribute on the valuation uncertainty point, if you could ping me a message in the chat, I'll bring you in later. So I'll move back to Paolo again. Paolo, you I mean, obviously you manage a number of institutional funds as well. How's this playing out within the institutional fund world?
Yeah, so there's probably quite a lot to be said here, so I'm conscious of time, so I'll probably rattle through this fairly quickly and rely on people asking questions about the areas they're more interested in hearing some more about. But just before I get into the detail, here we're talking about funds where we typically have investors which we would classify as more experienced, more sophisticated, funds which are going to be typically subject to much lighter touch regulation, and therefore the manager of these funds will have much more discretion as to how they respond in these circumstances, often driven by what's drafted into the fund docs. But the one thing that I think applies consistently, regardless of whether it's a wholesale or an institutional fund, is our obligation to ensure that we're treating all customers fairly and doing the right thing. So if I just now dive into some of the issues that we've been grappling with across a number of our institutional funds, and I think I'd start by saying you can't just apply. It's not a one size fits all. I think you have to look at each fund in isolation because they will have their own distinct issues and challenges. But in many ways, an open-ended fund. I'll come on to closed-ended later. But if I start with open-ended, in many ways, the open-ended institutional funds face the same issues as the NERS funds we've just been referring to, where, frankly, in relation to subscriptions and redemptions, those may well be taking at inflated pricing, where we have concerns around valuation. And I say concerns around valuation rather than specifically calling it valuation uncertainty, because whilst the FCA have mandated and specifically called out and given the valuer a role, or the valuers a role, in relation to having I suppose a contribution to make in relation to the suspension process by calling out material valuation uncertainty, and the valuers in that case are standing independent valuers, have a specific role under call, which I think is a bit different from the situation we have with many of these institutional funds, which are AIFs under AFMD, where the valuers have a role as valuation advisor rather than ultimate responsibility for the valuations. So I think it's incumbent, one thing I would say really early on is it's incumbent on us as managers to have regard to what's going in the market, regardless of whether or not valuation uncertainty and material valuation uncertainty has been called out by the valuers. So I think that's something we have to grapple with, regardless of what the valuers in each of the markets are saying. But the points are the same. Where you have concerns either declared by the valuers or your own concerns as AIFM with responsibility for valuation about the valuations that underpin your funds, I think you have to seriously be considering suspension as an option in order to ensure that customers are being treated fairly, where you have subscriptions and redemptions at potentially inflated pricing. But I guess what you do and how you do it will in large part be determined by what's in the fund doc. So that's got to be your first point of reference. The other thing, it sort of goes without saying, but has to be stressed, is making sure you've got robust internal oversight and governance throughout the process, and that you're engaging with key stakeholders throughout. An important point arises, in particular, in these types of funds, where more often than not you'll be operating over commitment strategies, where you have signed up or you've made commitments on a forward-looking basis, on the basis that you have undrawn commitments, which you'll draw down in accordance with the need to do so as you need to deploy the capital in the market. Now, clearly, if you're not able to draw down the capital because the fund is in suspension, you end up going from a valuation issue to having potentially a liquidity issue, where you're not able to draw down those undrawn commitments. Now, there are potential solutions, but again, I don't think there's a sort of one size fits all, and it will come down to what you're able to do in the context of a particular fund, and various other factors. So it might be that you're able to draw down your capital now, but price it later. You might have a revolving credit facility in place, which is locked in and that you can draw down upon. And then there's one other possibility, or I'm sure there are many others, but one other thing to think about is the withholding of dividends and distributions, which is a discussion topic in its own right. Now, that may not move the dial enough to deal with your commitments, but every little bit counts. But I'll come back to it. Fundamentally, you're going to be driven by what's written into the fund docs. And that may be that you're obliged to take certain actions, but more likely it will be a case of establishing what you can do in accordance with the fund terms, and engaging legal counsel on that early on is absolutely critical. Just touching on closed-ended funds, you may think those funds are immune, but where you have undrawn commitments, as you may have in those funds, you're up against the same issues, particularly where you have undrawn commitments from not the entire investor base, but from a small subset of investors or a subset of investors, where by drawing down at inflated pricing, you're potentially going to be prejudicing the interests of a certain group of investors. So it might be that even in a closed-ended fund, you're having to effectively suspend the drawdown of those commitments, and potentially creating the liquidity issues I referred to just a moment or two ago in the context of closed-ended, open-ended funds. Just to wrap up, I'll call out 3 other things that you might want to be thinking about. I touched on dividends, but a number of funds, institutional funds, might offer dividend reinvestment plans. And clearly, where the fund is in suspension, you may find that presents you with a bit of a problem, or at least where you have valuation concerns around valuation. You don't feel comfortable offering a dividend reinvestment option. So either you may want to defer that reinvestment or pay those dividends out in cash, subject to your liquidity constraints. There's a particular issue in relation to JPUTs, again on the dividend issue, where as Baker Trusts, you just can't withhold your income even if you want to, so something to think about. And finally, more of an accounting point that Rob might want to touch on, but bad debt policies, something I think everybody should be reviewing and revisiting and thinking about their bad debt provisioning, their approach to that, their policies around that, given that has a significant bearing on your level of distribution, on the basis that that's done on an accruals basis rather than a cash basis. So something to think about, and as I say, spend a bit of time tightening up your policies and processes around that. And the last thing I'll say is communicate. That's what you've got to do more than anything in this process, is talk to your investors, keep them appraised of everything that's going on, the rationale for it, and do that throughout the process.
Thank you, Paolo. One bit that you did mention there that I've been stressing to my clients as well is the importance of documenting all of this, so you've got an audit trail. I mean, the FCA have already said they're going to come back afterwards to check how people handled this. So you need to have minutes of all the meetings taken, everything fully documented as to how you reached the decision you made. At that point, I'll bring in Rob.
Wait, can I just say one thing in response to that? You say, and it's quite interesting, because you say after the event, actually for one of our European funds, institutional funds, that we've had to suspend for the reasons I've just outlined, the CSSF in that particular case was looking for that audit trail up front, not after the event.
Yeah, that's interesting, because I know the FCA said you have to provide a reason, but I think then they've said they're also going to be coming back afterwards. So that you have to notify them up front if you're suspending, and then they'll come back afterwards. Rob, I'll bring you in at this point. So I think you're saying this from a slightly different perspective as an administrator.
Yes, no, indeed. I mean, just I guess the headline, just before I sort of get into the detail, I mean, I sort of agree with Paolo. I mean, obviously, we deal mostly with institutional capital, and I think the LPs are taking a pragmatic approach at the moment. I mean, I think they fall into different groups. Some are more bullish than others, but we're not seeing, first thing to say, and across, obviously a very significant number of funds, we're not seeing any defaults as such. I mean, I think LPs are looking at their own liquidity and making an assessment of that on a portfolio basis. I suspect that they may escrow cash perhaps away from in certain cases, from new investment to just in case there are drawdowns on existing deals, because I think we probably will see that as certain, especially on value add funds where you have development that's being pushed out and so on and so forth. You may find that that LPs may have to bridge the shortfall, and so I think LPs aren't panicking at the moment. They're just trying to make sense of this in the same way that GPs are with their portfolio assets. I think it's a very interesting, slightly difficult timing, from our perspective. Obviously, we're just closing off 31st December year-end audits, and very difficult for people to react. I mean, most of the field work has been done, and so what we're seeing across the board is going concern disclosure. There is a lot of work that is going on behind the scenes to test cash flows, especially on slightly more prejudiced asset classes. So there is a lot of work going on behind the scenes, but it's hard to be accurate at this stage. And I suspect, I think Paul might have said, the Q1 values as well are not going to be fully reflective of what we're going to see, because there is in some cases still rent on an accruals basis that has come through and straddles the Q1 basis. So I think we're not going to get a full picture of an accurate assessment of values until Q2. But what we are seeing is again a sort of almost like a forensic analysis across the board, across all of our clients on cash flow. So they are taking out their DCS and they're almost auditing every component part, whether it's the debt side, effect on discount rates, potential, in some cases, obviously some clients have managed to get amortization holidays and interest holidays, so that has a positive effect. But at the same time, there will need to be, where there are capex facilities and so on, they'll need to be, perhaps the debt will be more expensive. That will have an impact. I think on the tenant side, if I just make comment on that for a moment, I think people are taking what I would describe as a mutually beneficial approach. I think that, again, even those asset classes that we think are safe and not typically in the sort of hospitality areas and retail are still affected by delays, simple things like viewings and marketing and things like that. I mean, and also uncertainty with, even if you're, say, a professional services firm, you've still got a lot of uncertainty in cash flows, quite lumpy, even in you'd think in sectors that you wouldn't think are affected. But on the other side, I think people are, they're absolutely, there's only a portion of the rent is being collected. That's pretty clear. I think that our clients are perhaps looking to try to, if they are doing some sort of holiday on rental, they are looking to try to tie that in with perhaps a renegotiations of the terms of the lease, maybe getting rid of the tenant break clause or extending the term of the lease, and so to try to at least recover something on the back end. But it's it all comes back to a forensic review of every component of the cash flow on the valuation side, and that is probably going to take place during the next sort of few weeks, couple of months.
Thank you, Rob. Before we move off the valuation, one point that has been flagged, and the valuation fund pricing, and Nick Brown, I think he's got some bandwidth issues, so I'll make his comment for him, which is that AREF and INREV had a webinar last week on fund pricing, and as part of that published the guidance on pricing in unusual circumstances in uncertain market conditions. For the full report's going to be published later in the year, but that bit's been published already. So that's available on the AREF website for those who are interested. And I think Deborah Lloyd's also pointed out that it's not universal across different markets, as Paolo said, are taking different positions on the impact of valuation uncertainty. Rob, you flagged up important issues on cash flow in your comments, which is the next topic we wanted to cover. We had the rent quarter day on March the 25th, and obviously there's been landlords have had very different experiences in the amount of rent they received on the quarter day. And Sarah, you, I know, have been heavily involved in this in your work.
Yes, that's right. So as you'd expect, we've been extremely busy on both landlord and tenant side in relation to the March quarter day. I think just to pick up on what's been said to date, the uncertainty is the piece that's really defining the negotiations at the moment and causing difficulty in those negotiations, really, because where we find ourselves in a world where it's extremely difficult to model how we're going to come out of the situation. So we don't know how long the crisis is going to last, and we also don't know what the world is going to look like when we come out of the crisis at the other end. So where tenants are at the moment having immediate cash flow issues, and there are conversations around that, that's one thing. Where tenants, as Rob said, are looking for further changes and more deeper variations to their lease, that's another thing, and that's actually a very difficult conversation for investor landlords to have at the minute. And that uncertainty is flowing down a great deal down into the asset management level, and it's quite interesting to see these negotiations from a bird's eye view, because you sort of have your initial phase, which is the present phase, and that's how do we deal with this present issue. And then there is the longer term view in terms of what we agree now, how that is going to affect valuations and our decisions going into a much longer period of time. But just to, I mean, the cash flow piece in relation to tenants, they obviously are having, particularly on the consumer facing side, where there is an obvious cash flow issue for them. And there is then a sort of switch in decision in terms of that company, in terms of the decisions that they have to be making, their directors have to be making, which is driving the decisions to a great deal. But it comes back to the bit around transparency and the flow of information, and where landlords feel that tenants are not being open and communicating efficiently with the challenges that they face and with the cash flow issues that they have, it's much more difficult for decisions to be given, for rent suspensions to be given, and for other terms to be given, compared to where you have a tenant who is being a lot more open with the cash flow issues that they're facing, the business challenges they're facing, and also which of the government packages they've taken up and which of those packages have not been available to them to be able to dictate how they use their premises going forward.
Thanks. And Guy, I know you've got views on this as well. What's been your experience as a fund manager, and in particular, what differences are you seeing between different types of tenants?
I think it's really important at this stage for all of us to realise that the occupiers are only 3 weeks into the lockdown as well. They've had quite a lot of operational issues they've got to deal with. And we've got to give them a bit of bandwidth in some of these discussions and negotiations. We have a very clear procedure of seeking information, really trying to understand the issues and how badly a business is impacted. And but for us, it's important to try and dig down into their cash flow and how likely they're going to be, if it's a default situation, and therefore how much forbearance we'll give them over a period of time. The concern is that actually March is going to be difficult, or has been difficult. We've still managed to collect around 70% for my particular fund, so an okay assessment with quite a lot of monthly rents coming through. But it's really going to be June is going to be the real issue, and we've really got to try and support our occupiers through that. We consider our fiduciary duty not only to collect the rent, but also to ensure that the businesses survive, so we can collect the rent later on in the year as well.
I think that's really good. Sorry, that's a really good point, because I think a lot of the conversations at the moment are very much focused on the March quarter date. But even if we get to the June quarter date and we're suddenly, the world has returned, there is potentially quite a big sort of debt that companies are taking into that June quarter. And to my mind, it's going to take considerably longer than just one quarter to sort out the issues that this complete unprecedented lockdown in terms of business has created.
Absolutely, Guy. Sorry, your fund is also ungeared, which puts you in a slightly different position from people who've got debt to service.
That's absolutely correct, John. We're in the lucky position of not having to look at loan-to-value covenants or interest cover. Certainly, we haven't really seen that much impact on values yet, but we're very early days, so you probably wouldn't expect that. But the issue with debt being in vehicles is that you will have things like interest cover you've really got to be looking out for, and that's part of that whole DCF modelling, which Rob was mentioning earlier. It gives us a slight advantage at the moment, and in some ways the cash protects our investors from any capital value pools as well, but gives us lots of working capital if we need it.
Paolo, you have a mixture of sort of geared and ungeared funds within your portfolio. Are you seeing an issue with some of the debt covenant aspects of this?
I think you're right, John. We have a range of funds, leveraged and unleveraged, and we're spending an awful lot of time analysing each of the positions that we have and stressing them. So I think the reality is stress is almost inevitable. But I'll come back to what I said at my closing remark about communicate. Engage with your lenders, because frankly, based on my experience, they're being very sensible and pragmatic about this situation. And they, in the same way that guys just talked about working with tenant banks, will almost certainly want to work with us to achieve best outcomes for everyone, frankly. But so I would encourage regular engagement and open, honest, and transparent communication with lenders. But our experience to date has been a positive one.
Thanks, Sarah. I mean, looking at the sort of more extreme examples, I know you've done a lot of work on CVAs, and there are also changes to the insolvency rules that have been brought in as a response to this. What's happening at the more dramatic end of this, if you like?
I think there's not a one size fits all answer to that, because it really depends on the position of the landlord, if you like, and how far they can go in relation to concessions, whether that's because of some of the issues that we've talked about today, or because of what the lenders are requiring them to do, or what have you. And it also depends on the tenant, and that piece back to the communication. Are they really in difficulty, and having a kind of conversation along that line. The direction of travel is very much one of giving companies space to recover, and that's sort of the general mood. So the changes in the insolvency legislation that haven't yet come through, but we're expecting them to come through, were all focused around moratoriums and giving an initial month to companies to have big breathing space to put their restructuring plans in place and the like, alternatives to CVAs, other ways in which companies can start to restructure their debts and relook at the position that they have. What's interesting and what's different about this is that normally when you give restructuring advice, you look around at a company's creditor pool and you identify certain stakeholders who, under normal situations, you could say there's enough fat there for them to take a bit of pain to allow this company a bit of breathing space. Here, there isn't really any one stakeholder that you could pick on in that way, for want of a better word, because actually everybody is feeling that pain. So there's no fat to expand into. So the discussions are very different. There's sort of knock-on consequences for everybody, where anybody takes a concession. But the interesting piece from a landlord and lease perspective on that is, whereas in the last few years we've very much seen the narrative around the landlord-only CVAs, which is, well, you know, landlords are there, they've had a lot of rents, traditionally sites have been slightly over rented and they can take the pain, and for business continuity reasons we need to make sure that we're paying other creditors, so we'll just put the pain onto our landlord creditor base. That narrative is very different now because there is no business continuity. So actually there isn't the same justification for saying, well, we'll withhold our rental payments, but we'll pay other creditors. So that changes the decision making, I think, quite substantially.
Can I just add? I mean, on the what we're seeing is up front at the start, a prelude to any rent discussions is requests for financial information. I think that is quite important. It's a quid pro quo to actually get some visibility, and that can help to break down barriers. But you know, there are obviously a lot of very unfortunate stories, but equally there are some people that have inadvertently benefited. And I was chatting to the CEO of one quite large retail concession who had negotiated rent reductions, rang up the council, so they weren't getting any rates, and found that their online sales have actually jumped up, and they're actually up like for like 15% on sales. So, you know, these are going to be sort of in the minority, but I think requesting financial information should help to break down those barriers into trying to get a sort of a real detailed, granular understanding of each other's predicament.
I think that's right.
I was going to say there are some anecdotal stories of tenants who are doing really rather well and are still asking for rent concessions, etc. So
and where we saw in the press over the weekend with, you know, some landlords getting a bit of a bad rep for taking a more, you know, let's issue a statutory demand, let's force the rent payment, now getting a bit of a sort of bad reputation in relation to that. But actually, that's very much the point. If you have a tenant that, you know, you need to be convinced, I suppose, that actually that tenant is facing those difficulties. And where most leases generally don't, it's not necessarily institutional that the tenant has to share its financial information, but if the tenant wants a proper discussion about this, then they need to be being open and transparent with their balance sheet.
Thanks, and I'm sure that's something that we'll pick up on subsequent calls. I mean, the intention is that this webinar was to be the first of a number, and we'll keep it, and we'd keep it short and snappy. And we have run out of our allotted time, so I'm going to bring it to an end in a minute. Do any of the panelists have any final comments before we close? First, I'll start with you, Sarah, and move round.
Yeah, I think, I mean, my main reflection on this really is I'm interested in the world that we emerge into after this, and I think from an asset management perspective, that's going to be quite interesting in a world where, as Paul mentioned at the start, ESG was sort of the #1 issue going into this year. If anything, this crisis has brought certainly the social element of that and probably the environmental element of that to the fore. And I think that we don't yet know if we could crystal ball gaze and know the way in which people are going to change and the way they relate to their bricks and mortar. That would be fantastic to know that now, but I'm pretty sure it'd be very different. And it will be how quickly can we adapt to that, and the effect that it will then have on residual values if you don't.
And thank you, Rob.
Well, yeah, I mean, I think we've mentioned this in one of the planning calls, but I'm quite interested in, you know, I haven't seen too much feedback from the banks at this stage, and you know, obviously a month ago there was you know, there was no issues, and everything was you know, running reasonably smoothly. Suddenly, you know, they're not geared up to take on assets onto their book and so on. So, you know, obviously they won't be doing an assessment until the end of Q2, I imagine, either. But you know, I would be quite interested to understand how they're thinking, because obviously they've got onward obligations as well. And whereas they're being quite helpful at the moment on the whole, obviously, you know, it'd be interesting to know how long that's going to continue.
Thank you, Rob. Guy?
Probably more on the social side, actually. I'm just really pleased to see how the industry's responded by offering up buildings to the NHS and support more widely. And I think that's a really good thing for us to be doing, and you know, we should be shouting about it and communicating it so that sort of landlords aren't just getting a bad rap in the newspapers. You know, we are there to try and provide some support for, you know, the NHS at this difficult time.
Thank you. Last but not least, Paolo.
Yeah, so I'm just going to pick up on Deborah's comment through the Q&A. And I touched on this when I spoke earlier about certain markets which haven't declared material valuation uncertainty, and Germany being one of them. So a bit of an outlier, and we're going through a process of having discussions with the valuers in that jurisdiction as we speak. But I'm going to come back to the point I made, which was regardless of whether the valuers are calling out uncertainty or not, particularly where we're operating under AIFMD, we have an obligation to do the right thing and to take responsibility for the valuation process. And in these very uncertain, volatile times, regardless of what the valuer is saying, I think it's incumbent on us as AIFMs, for those AIFMs on the call, to be providing that robust challenge internally around the valuation process and making the right calls on the back of that challenge.
Thank you very much, Paolo. Thank you everyone for attending. A few closing comments. We're going to have another one of these, so if you have ideas for the next one, I think we picked up a few things from the discussion today. Could you email them through to AREF, and we'll pick them up in the next webinar. We have, in addition to the follow-up to this, we have a couple of other webinars coming up for AREF. Paul mentioned that there'll be a webinar with Asian members contributing from what's happening over there. I believe details of that will be going on to the AREF website this afternoon. And for those on more tax technical matters, there's a webinar on the 16th on the consultation on asset holding companies that AREF and the IPF will be responding on. So there'll be a call to discuss that. So if you go and have a look at those on the website. So finally, can I thank the panelists? I'm not sure that they'll hear a round of applause, but you're all in your separate rooms. But thank you very much for joining in. I hope you found it useful. Please send us any comments afterwards. Thank you.